All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and the non-technical aspects of the investment banking process. Hello, my name is Alex Mason, and I am your host. Thanks for joining me. Today, we're going to be talking about the third financial statement, which is the cash flow statement. And I love talking about this one because I think it's just so vital to understanding how a business works financially. So let's go ahead and define it for you and then talk about the major sections of the cash flow statement that you're going to need to know as an investment banker. So let's go ahead and go to the whiteboard. Okay, so the cash flow statements, which you'll see abbreviated as CFS. Now, like the income statement, the cash flow statement records over a certain period of time. Now, the balance sheet was a little bit different. It only records a snapshot in time, kind of like if you took a snapshot of your bank account balance today, that's kind of what a balance sheet is like. Cash flow statement records over time, so usually over a quarter or over a year. And then the cash flow statement tells us what money is actually flowing through the business and how is it flowing through the business. The income statement and the cash flow statement are similar but different. The income statement tells us an accounting of revenue, expenses in order to get to profit. Cash flow statement tells us how money actually moves through the business. So they're connected, but they're different. So there are three major sections of a cash flow statement. There's cash flow from operations, cash flow from investing activities, and then cash flow from financing activities. And so if you add up what's going into and out of the business in each of these three sections, ultimately it's going to tell you the change of cash in the period. So for example, the change of cash in a year's time, for example. Now let's walk through each of these three sections in order to understand what their importance is and what we can look for. So cash from operations. This is the amount of money that the business is actually generating by being a business. So if a company is selling cars, for example, this is the actual cash that the business made from getting cars. Now, this is not the same thing as profit. This is important to understand. The net income from the income statement is a different concept. The cash from operations is the actual cash that was received. And we'll talk about the difference between cash and revenue in another episode. But fundamentally, when a company makes revenue, it's because it earned it. It actually delivered a product or service. Cash is just when money flows into the account as a result of the business's operations. So this is cash from operations. And if a business is young and growing, this number will usually be negative because the company isn't making money yet. So for young firms, this will usually be negative. For mature firms, this will be a positive number because investors are going to want to see that the business is actually generating cash. Now, cash flow from investing. What is this? This is money that goes into and out of the business related to its investment activities. Now, when I say investment activities, I'm talking about maybe a company upgraded a factory, for example, and they just spent a lot of money on building up their plant. So maybe this could be like adding to PP&E, for example. Another example is acquisitions and divestitures. So businesses will often purchase other companies in order to roll them into their own operations. That's where you would see that kind of transaction. So you could see acquisitions here. And then you can also see divestitures, which is just a fancy way of saying the company sold a piece of itself to another company. So those things are important because the cash that goes into and out of the business is very real in terms of cash from investing, but they're not actually related to the operations of the business itself, right? Like if you have a factory making cars, if you buy a factory, that's going to reduce your cash levels for that year, but that didn't really have anything to do with the money that was generated from the operation of selling cars. So that's why this is broken out in a different section. Now, if we go one level below, it's cash from financing. This is where the financial side of the business comes into play. So if a company is paying out money in dividends, for example, to its shareholders, you would see that here. So dividends, and then you would also see money spent on share buybacks. So a company buys back its own stock in order to increase the relative ownership for its shareholders. You would see that here. So buybacks. And then also the opposite is true. If a company is selling shares and making money by selling new shares in the market, those proceeds would flow into the company through cash from financing section. So buybacks plus share issuances. And then the other big category here for cash from financing is debt. So if a company is doing anything related to debt, so if they're paying off their debt, if they're raising new debt, that's what you're going to see here in the cash from financing section. And so if you add up all of these things, they kind of flow down, ultimately resulting in a net change in cash in the business over that period of time. So that's the cash flow. That's the cash flow statement and the fundamentals of how it works. So that's the fundamentals of the cash flow statement and how it works. Thank you so much for joining me. Next time we're going to be continuing these accounting concepts. And now that we've covered the basics of what these three statements are and the fundamental operations of how they work, we're going to start seeing how these statements connect to each other and how we can apply some real world problems and scenarios to these statements. Okay, thank you so much. I'll see you on the next one. Bye.